Back in 2018, I called Bitcoin rat poison squared. And today, 7 years later, we're watching that poison work its way through the system. In just 6 weeks, Bitcoin has plummeted from its October high of $126,251 to around $90,000. That's a 28% collapse, erasing every gain made in 2025. Over $600 billion of market value has simply vanished in a thin air. But here's the real concern. This isn't just Bitcoin. The entire cryptocurrency market has lost over $1.2 trillion in the past 42 days. Ethereum has crashed nearly 40% from its peak. In October alone, $19 billion in leveraged positions were liquidated in a single day, the largest liquidation event in cryptocurrency history. And just last week, another $1.1 billion evaporated in a single day. The so-called smart money is running for the exits. Bitcoin ETFs, which were supposed to legitimize this speculative mania, saw nearly $900 million withdrawn in a single day. The Fear and Greed Index has plunged to 11, levels not seen since the FTX collapse of 2022. What we're witnessing is not a correction, my friends. This is the predictable unraveling of a speculative bubble built on nothing but air and hope. Let me start with a simple question I've asked for years. What does Bitcoin actually produce? I've sat through countless dinner parties with bright young people insisting that cryptocurrency is the future of money. They talk about blockchain, decentralization, and digital scarcity. But when I ask what Bitcoin actually creates, what intrinsic value it delivers, nobody can answer me. Compare that to something tangible. If I buy a farm in Nebraska, I know exactly what I'm getting. That farm produces corn year after year. Apartment buildings generate rent. Businesses like Coca-Cola and Apple produce earnings and dividends. These are productive assets with intrinsic value. Now imagine someone offered me all the Bitcoin in the world for $25. Would I take it? No. Why? Because it doesn't produce anything. It doesn't create anything. It simply sits there, hoping someone else pays more tomorrow than I did today. That is speculation, pure and simple. Look at the numbers. Since October 6th, when Bitcoin hit $126,251, $600 billion of so-called market value has disappeared. But here's the truth. That value never really existed. It was phantom wealth, generated by the collective delusion that digital tokens were worth what the last person paid for them. Compare this to shares in Berkshire Hathaway. If the stock market closed for 5 years, our businesses would still produce value. Insurance policies would be written, power would be generated, freight would move. The underlying value persists. But if cryptocurrency exchanges shut down for 5 years, your Bitcoin produces nothing. Zero. Just a string of numbers on a computer, hoping someone wants to trade real money for your imaginary money. October 10th was a wake-up call. $19 billion in leveraged positions liquidated in a single day. To put that in perspective, that's more than the entire market value of Ford or Delta Airlines wiped out in 24 hours. And what triggered it? President Trump's announcement about potential tariffs on Chinese goods. One policy announcement, $19 billion gone. Then, November 14 saw another $1.1 billion liquidated in 24 hours, affecting 246,000 traders. These weren't casual investors. They were highly leveraged speculators. Over 70% of these positions were long, meaning everyone was betting on prices going up. When a market tipped, the collapse was catastrophic. Bitcoin ETFs were supposed to bring stability and institutional legitimacy. Initially, they did. Over $100 billion flowed in, pushing Bitcoin to record highs. But when prices fell, institutional money exited as quickly as it came. November 13th saw $870 million withdrawn in one day. Over 3 weeks, $2.6 billion fled Bitcoin ETFs. Ethereum ETFs are even worse. $1.2 billion in November outflows, with no new inflows. This is institutional rejection, not adoption. Let's break down why this happened. The total cryptocurrency market hit $4.4 trillion at its peak. Today, it's $3.2 trillion, a $1.2 trillion disappearance. But that wealth was never real. It was based on the assumption that someone else would pay more tomorrow. Consider this. 93% of all Bitcoin hasn't moved in a year. Yet, the market values all 19 million coins based on transactions of just 1 to 2 million tokens. When prices drop, the illusion of value collapses. And that's exactly what we're seeing now. The Federal Reserve has signaled that interest rates will stay higher for longer. Speculative assets, like cryptocurrencies, get hit hardest in this environment. Easy money inflates bubbles. Tight money pops them. The dot-com crash, housing crisis, and now the crypto bear market all follow this same pattern. Fear is contagious. When a leveraged, speculative market is spooked, panic spreads. Bitcoin recently dropped below its 50-week exponential moving average, a death cross in technical analysis. While charts don't cause crashes, they reveal market psychology, extreme fear. Leverage amplifies everything. A 10x leverage position can double your gains or wipe you out completely. This is exactly how the $19 billion and $1.1 billion liquidations occurred. A cascade of forced selling, each wave pushing prices lower. Crypto enthusiasts offer many rationalizations. Digital gold. Gold is scarce and chemically useful. Bitcoin? Just data. It has value only because people agree it does. Inflation hedge. During high inflation, Bitcoin crashed from $69,000 to below $16,000. Real inflation hedges are productive assets that adjust with prices. Blockchain revolution. Blockchain is technology. Bitcoin is an application with poor transaction utility. Revolutionary tech doesn't guarantee investment value. Limited supply. Scarcity without utility is meaningless. Coca-Cola, Apple, and other productive companies are scarce and generate value. Bitcoin? It's just scarce. Bitcoin is testing support around $90,000 to $95,000. If that breaks, we could see $80,000 or lower. Over-leveraged institutions could trigger further liquidations. The crypto bear market is textbook panic. Leverage, unrealistic expectations, dwindling liquidity, and a self-reinforcing loss of confidence. If you own cryptocurrency, ask yourself, why do I hold it? If it's to get rich quick, that's speculation. Your thesis is failing. If you truly believe in its intrinsic value, a bear market is an opportunity to buy more. The fact remains, productive assets compound value over time. Non-productive speculative assets like Bitcoin do not. They can only increase if someone pays more tomorrow. Eventually, reality prevails. Focus on quality businesses, productive assets, and investments you understand. Don't gamble with money you can't afford to lose. The crypto bear market is painful, yes, but it's also a reminder of timeless investing principles. Don't be the one left holding the bag when the music stops. I take no pleasure in seeing people lose money. My goal is caution, reason, and clarity in a world of hype. The fundamental principles of investing haven't changed in 94 years, and they won't change in the next 94. Focus on productive assets. Understand what you own. Be patient. Be rational. Let the crypto bear market run its course, and learn from it. Good luck. And remember, it's always better to be safe than sorry.